If we find ourselves in a market where mortgage rates are higher than we would typically like, then if you're in the market for a new mortgage or new home, you probably wake up and say, did mortgage rates go up today? Sure, a higher rate can pose an affordability challenge for a lot of people when it comes to buying a new home. But in this video, I'm going to share some tips with you on how you can save some money and maybe secure a little lower interest rate and make that new home affordable for you. What's up, guys? My name is Stephen Kodabash, and I'm a realtor located in the northern Atlanta area, and I get to help people buy and sell houses every day. So when it comes to mortgage rates, I know none of us, if we're consumers, we always want a good deal, right? None of us want to deal with high interest rates because that ultimately means that we've got to pay a little more money each month for our mortgage. But it's an economic thing, right? It's part of economics, and it's part of the market going up and down. There are peaks and valleys. So depending on the circumstances, rates are lower, right? And then sometimes rates are higher. And when I say higher and lower, of course, that's all relative, right? It's relative to what we're used to. I'll give you an example. Back when I was a kid in the early 80s, goodness, the interest rates could be 12, 13, 14% on a mortgage. And historically speaking, that's very high, right? Very high. Well, back, let's say we're in 2023 right now. Think back about 5 years ago or so, something like that. We were all spoiled with 3%, upper threes, even 4% rate, and that, historically speaking, was low. Well, what's normal, right? What do you call normal? But if rates are higher, then there are some things that you can do to try to save some money and not have to deal with that higher interest rate. Hold up, before we go further, do me a favor and please hit the like button and hit the subscribe button for me. I appreciate it. What you can do is think about an adjustable rate. So a lot of us have heard these and heard them referred to as ARMs. So it's an adjustable rate mortgage, and oftentimes that rate is a little bit lower than the standard 30-year fixed rate that you may be looking at. So do the math on it and see if it makes sense for you to grab that adjustable rate. Because here's the good news. Sure, that adjustable rate, with that rate, it could go up, right? But if it ever gets to the point where it's uncomfortable for you, you could always try to refinance. And I know none of us have a crystal ball, so we cannot predict market conditions, as cool as that would be. We can't do that. So with the adjustable rate, it is a little bit of a risk, but it's something that you could consider if that normal 30% fixed rate is a little too high for your taste. If you have the financial means to do it, consider a 15-year fixed rate loan. A lot of us jump into a 30-year fixed loan because you're taking the term and you're extending it out, right? You're extending it out to 30 years, which means that your monthly payment is going to be a little bit lower. But from a cash flow standpoint each month, if you can afford a little higher payment, then take a look at a 15-year note, because on a 15-year fixed note, your interest rate is going to be a little bit lower. And so what does that mean? That means that you pay a little less interest. So you might be one of those people that, you look at the higher rate and you might say, holy cow, I just feel terrible paying that much interest. I'd rather compress it into 15 years, get a little lower rate. Sure, my payment's a little higher, but when I look at the interest expense each month and over time, it's going to be lower. So you could consider that route if it's possible for your situation. Have you ever heard of the term buying down the interest rate? Some people might say you're paying for points. So what that means is you take the interest rate, and I'm just going to throw a random example out there at you. So let's say the interest rate is 6%. That's the standard 6% rate. And you've got a lender that says, hey, you can buy down that rate so you can actually pay a little more money up front to get a lower interest rate. So once again, I'm just going to throw out a random example. 6% is the normal rate. The lender might say, hey, I can get you 5.75%, but you're going to have to pay $1,500, let's say. So you can get the 5.75% rate, but up front, you're going to have to pay $1,500 to buy down that interest rate. So buying down an interest rate is another route you can take to get a better interest rate. But once again, you've got to have some cash up front to be able to buy that down. So once again, just look at your situation, look at your budget each month, look to see how much cash you have on hand to see if that makes sense for you, because it might not make sense, but hey, if so, jump on it and buy down that rate. Guys, just keep this in mind when it comes to the market and interest rates. Sure, that rate might be a little bit higher than you would like, but if you find a property you need to move, right? If you need to move and you find that property that you really like, go ahead and secure the rate, because I will tell you that at least in my area here in the northern Atlanta area, I know there are lender partners that I have that will offer to refinance for you later. So let's say you jump into a mortgage now and it's higher than you would like, say 2 years down the road, it comes down, the rate comes down 2, 3 points, whatever it is. Well, there are lenders that have a guarantee that they say, hey, look, if that happens and you want to refinance, then come to me and I will refinance that for you, and I'll take care of most, if not all, the closing costs to refinance. So make sure you check around with different lenders, because they offer programs like that when rates are higher, because they know people will jump into a mortgage that is probably not the most favorable in terms of the rate, but if you execute that first loan with them, then come back later down the road when rates are lower and they'll help you out on the refinance, which is huge. Y'all, I hope this video was really helpful. The math and everything that's involved in real estate, that's one of my favorite parts of it. You know, I love looking at different scenarios when you talk about what to put down, what the interest rate looks like, what type of loan I can get. When you do all the math and juggle those numbers, it's something that I really enjoy speaking with my clients about. So I hope this video helped you out. I hope that it helped for you to be able to take a look at, hey, the higher rate, right, it's not ideal, but here are some things that I can do to reduce that rate and maybe save myself a little money. So before you jump off my channel, do me a favor, take a look at this other video that I've published where I talk about home insurance. It's a big question. What does my home insurance cover? Things come up, things pop up on your property, in your home, and you might have to submit a home insurance claim. But in this video, I talk about those things that home insurance covers and things that it might cover. I said that wrong. I talk about things home insurance will cover and won't cover. Thanks so much for tuning in. And yep, I will catch you guys on the next one. You know it.